Hello and welcome, everyone. It is officially 11 o'clock and we'll get started here. Thank you so much for joining us at the One Big Beautiful Bill Act Impacts You Can't Ignore webinar hosted by Dean Dorton. Presenting today are Elizabeth Leatherman and Allison Carter. They are both tax directors in our Lexington office. So today during the webinar, we will be covering these impacts from the OBBB Act. If you have any questions throughout the webinar, please use the chat feature, which can be accessed by clicking the chat icon at the top of your screen. We will be monitoring it throughout the presentation, and we'll make sure to share any technical questions with our presenters at the end. If we do not address your question during today's presentation, contact information is included at the end of the materials, so please reach out after as needed. This webinar is being recorded and will be emailed to you by the end of this week or early next week, so please be on the lookout for that. Thank you so much for joining us today, and do not hesitate to ask questions. Before we bring out our speakers, we would like to welcome Anthony Allen from the Commerce Lex to say a few words and welcome everyone as well. Thank you so much.
Thank you, Julia, and appreciate Dean Dorton partnering with us to provide this webinar. My name is Anthony Allen. I'm the VP of Public Policy at Commerce Lexington, and we appreciate everybody tuning into this. We've had some updates on the One Big Beautiful Bill as it's been passing each chamber of Congress the past few months. And so just to have a good, accurate breakdown, we wanted Dean Dorton to come over. And I'll just say a few words about our policy advocacy at Commerce Lexington. We focus on enhancing the business climate of the greater Lexington region and our economic competitiveness to the local, state, and federal levels of government. And so we collaborate with our member stakeholders like Dean Dorton, and we work with those policy councils to set our priorities and be your all's voice and trusted source. And whether it's at Lexington City Hall or Frankfurt or Washington for federal issues. So we appreciate your all's time, and we thank you guys for tuning in and look forward to some pertinent information from the One Big Beautiful Bill.
Thank you. Good morning and welcome to Dean Dorton's coverage of the One Big Beautiful Bill Act. Before we get started, just a little background on the bill. It is over 800 pages. It's over $4 trillion in revenue reductions over the course of a 10-year reconciliation period. It contains both revenue raisers and tax cuts, and it's also a combination of temporary and permanent revisions. And so the effective dates of these provisions will vary, and so we'll talk about that as we go through it. But the bill permanently extends many provisions in the Tax Cuts and Jobs Act of 2017. And the TCJA was one of the largest pieces of tax legislation that we have had since 1986. And many of those provisions were set to expire in 2026. And so some of those provisions were a reduction in income tax rates, increased standard deduction. There were some business provisions such as bonus depreciation and the qualified business income deduction. And so we'll go over some of that as we go through. The bill also aimed at fulfilling some of the president's campaign promises. And so there is much more than what we're going to discuss today that's contained in this bill, but we wanted to highlight some of the individual and business provisions that may be more impactful to you. And so to kick off with individual income tax rates, so the TCJA lowered the tax rates to 37% as the highest tax rate. Before that, it was 39%. And so the bill makes those tax rates permanent. They will be, they were set to expire in 2025, so those are now permanent. There is an inflation adjustment extension that's provided for the 10, 12, and 22% tax brackets that helps maintain that value beyond just 2025. And then the state and trust rates are permanently set at 10, 24, 35, and 35%. So with the TCJA, we had an increase in the standard deduction. And so the bill makes this permanent. So for 2025, single standard deduction will be $15,750 and $31,000 for joint filers. And this will be adjusted for inflation after 2025. Prior to TCJA, we had personal exemptions. So you could take an extra exemption for taxpayers and then also for dependents. And those were eliminated with TCJA, and they're also permanently eliminated. So itemized deductions. So the bill does repeal the pre-TCJA piece limitation, which reduced itemized deductions for high-income taxpayers. It was an overall deduction on your total itemized deductions for the year. So starting in 2026, even though this has been repealed, in 2026, there's a new limit that caps itemized deductions for individuals that are in that highest 37% tax bracket. And it puts them it puts them in a place where it's allowed under the 35% bracket.
I think, Allison, that I always like to know kind of, well, what is the 37% tax bracket? So I went ahead and made a note to explain that for 2025, that is $626,000 and change for a single filer and $751,000 and change for a joint filer. And the way that the law reads is it's a reduction of your itemized deductions of 2/37, thus effectively getting it back to what it would be at 35% over the lesser of, the amount by which you exceed the 37% bracket floor or your itemized deductions in total. So not, once again, nothing new in terms of tax law being more complicated than perhaps it maybe needed to be, but we'll muddle through.
Right. Thank you. So, as Elizabeth mentioned, while this does simplify things, it also puts limitations on high income earners.
Other changes to the itemized deductions is a permanent extension of the disallowance of the so-called 2% miscellaneous itemized deductions. This came about, of course, during the Tax Cuts and Jobs Act, and is really meant to kind of get at those miscellaneous items that were previously already limited. You had to kind of exceed 2% of your AGI before you got to deduct the first dollar. And those are things like hobby expenses, employee business expenses, investment fees, tax prep fees, and certain legal fees. There have been some carve-outs from this after the enactment of the TCJA, including for trusts and estates. There's a new category that is still considered a miscellaneous itemized deduction, but not subject to 2%. And so it is not disallowed, and those are like administrative costs of trusts and estates. But now, starting in 2026, there's going to be another carve out from the 2% miscellaneous itemized deductions for educator expenses. You might know that we've kind of historically had a $250, and I think they bumped it to $300 deduction for qualified expenses of educators purchased personally to be used in their classrooms. And this was what we call an above the line deduction. It wasn't an itemized deduction at all. If you were a teacher or an educator, and you spent money out of your own pocket on your classroom, you could just take this, rather small deduction. I don't think anything has changed with that deduction, but there is a new category added to itemized deductions, and the definition of unreimbursed educator expenses and who might qualify has been expanded somewhat to allow for things like coaches and just aides, paraprofessionals, things like that. And from what I'm reading, this is in addition, again, to the $300 above the line deduction, and there shouldn't be a cap on this particular category of miscellaneous itemized deductions, again, starting in 2026. And I'll mention, which will come up a lot, that regulations still need to be issued for a lot of these provisions. And I can't speak for Allison, but I have not personally read all 800 pages of the bill. I have read a lot of the sections that we're going to be covering today, and it leaves room for some interpretation, and that's what we will be waiting on the IRS to do when they come back with regulations. Also, the alternative minimum tax, which was really has not been a thing too much since the TCJA, due to some expansions of like where it kicks in and the thresholds. That is still in effect, made permanent by the recent act. And the only tweak is that phase outs have been adjusted. I think there was a 25% phase out over certain income levels that now might be 50%. So it will start to affect, again, those higher income taxpayers a little more quickly than it did before. But otherwise, all the things that we liked about it originally should still remain in effect.
Okay, so the child tax credit, so the TCJA expanded the child tax credit, which was set to expire in 2026. It allowed for 2025, the bill made this permanent, and it allows for a maximum tax credit of $2,200 in 2025. This will be indexed for inflation. For any children under the age of 17, and 1,700 of that is refundable, which is also indexed for inflation. There is still the additional other dependent credit of $500 that we had, and that's for dependents, that someone that would be a qualifying dependent that's other than a qualifying child. And then the phase out was expanded under the TCJA, which is also permanent, 400,000 for joint filers and 200,000 for individual filers. So the state and local tax deduction. So this is one of the bigger impacts to the itemized deductions. So the TCJA capped the state and local tax deduction at $10,000 through 2025. And so this would include your state and local income taxes, any real estate taxes, or personal property taxes. And those were all capped at a total of $10,000. So the bill increases that SALT cap to $40,000 for 2025, and then there's a 1% annual increase through 2029. The cap would then revert back to the $10,000 in 2030. So the cap is also further reduced by 30% of the amount of your adjusted gross income that exceeds a certain threshold. So 500,000 for 2025, which increases 1% annually through that 2029 period. So when you get to, currently for 25, when you get to income of 600,000, you will be phased out of that 40,000 cap deduction, and it will revert down to the 10,000. So it cannot reduce that SALT deduction below $10,000 that we originally had. So charitable contributions for individuals, there's a new limit on charitable contribution deduction that imposes a floor on the amount that you can take. So it's a 0.5% of your AGI starting in 2026. So any charitable deductions would have to be above that amount, and then it would still go into the overall itemized deduction limitation. It's whether you can itemize or not. So the bill does provide a charitable deduction for those individuals that cannot itemize. So it's $1,000 for individuals and $2,000 for joint filers. So any non-itemizers that do use that charitable deduction can only be made to what's called a qualified charity, and that's going to be your public charities. So no donor advised funds, supporting organizations, or private foundations. And then the bill also extends that 60% adjusted gross income limitation for any cash contributions to public charities. So again, not your private foundations, supporting orgs. And so then,
Allison,
yes,
the planning opportunity here, as you and I previously discussed,
yes,
is, those either bunching charitable contributions into a given year. 2025 would be a great year for that because this doesn't kick in till next year. Or utilizing those qualified charitable distributions from your retirement accounts to kind of just avoid the limitations altogether. Because with this floor, which affects everyone who itemizes and contributes to charity, along with the overall itemized deduction limitation for certain high income taxpayers, this does start to add up to be real numbers. This is one of those revenue raisers. So planning opportunities abound, but I would expect most charities on the call to be expecting to potentially receive more in 2025 than maybe they budgeted for, simply because none of this kicks in until next year.
Yes, thank you. And as Liz mentioned, this is a planning opportunity, and this is really one that we started, we saw a lot of coming from the Tax Cuts and Jobs Act, and it's probably going to make it even more important with pensions and the changes to the itemized. So the home mortgage interest deduction, so pre-TCJA, you could deduct your mortgage interest expense on acquisition indebtedness up to $1 million. So the TCJA capped that acquisition indebtedness at $750,000. So the bill makes the $750,000 permanent. It also eliminates the deduction for interest on home equity debt and makes that permanent. So 529 plan expansion. So tax exempt 529 plan distributions can now cover more of your K through 12 expenses related to the enrollment or attendance. So allowable expenses would include tuition, books, online materials, test fees, therapy for disabilities. And it also increases that annual per beneficiary limit from $10,000 to $20,000 beginning in 2026. There is a new scholarship credit. It's a new tax credit of up to $1,700 for cash contributions made to what's called a state-approved scholarship granting organization, or an SGO. So SGOs will provide scholarships to elementary and secondary students, and this credit can be carried forward for 5 years. So if you're not able to use it in 1 year, you may carry that forward. It doesn't apply until 2027. And then the scholarships from those recipient individuals would be excluded from gross income. And so states have to submit lists of what is a qualifying SGO to the IRS annually for them to determine compliance.
Allison, I think that 2027 start date is meant to give the states some time to kind of consider this and,
Right.
get their programs in order, since this is kind of a brand new item coming
Yes,
out of the
agreed.
recent act.
And of course, there will be questions about what is going to qualify for an
Yes.
SGO. So
Yes.
we'll have to await guidance on that.
Okay, affecting student loans and casualty losses. The student loan interest, or the forgiveness, is permanently excluded due to death and disability. That came about because of the Tax Cuts and Jobs Act, and now is extended for everyone. I remember when I was in school incurring my student loans, they told you, don't forget, not even dying get you out of this. It was a little bit scarier times back then. There is a permanent $5,250 exclusion from gross income for employer payments towards your student loan expenses or educational assistance programs. And these amounts are indexed annually for inflation starting in 2027. Casualty losses are another personal item which have had a little bit of shakeup in recent years post TCJA, which kind of limited things to federally or state declared qualified disasters. So when you hear that FEMA comes in, I think in Kentucky at least, we're all familiar with the fact that all Kentuckians, individuals and businesses got a tax filing delay for 2024 purposes until November 3rd of this year. That's kind of the type of disaster that individuals have been able to deduct against on their tax returns. And we've actually added this term qualified disaster loss. for these specifically named disasters that, where the federal government or now the state governments are allowed to declare them, in terms of what is able to be deducted. I did also just read that there is a new, separate from the OBBBA, a new fast track provision where state governors can potentially get those tax filing deadlines more quickly than they've been able to receive them in the past. So that'll be helpful as well. Typically, a casualty loss from theft or disaster used to be limited. It had to exceed 10% of your AGI, and I think $100. But these qualified losses have to only exceed, I think, $500 flat in order to start to be deductible. But the qualified disasters, this special, carve out, those are going to be coming to a close here quickly. I think the disaster had to have occurred by the passage of the bill on July 4th, and it had to be officially declared by September 3rd. So more to come on that, once this kind of starts to shake out. But I guess if you've been to the IRS website that kind of goes through what is a federally declared disaster, there are lots more than I ever realized there would be. I've visited that page more often than I'd like to admit, just because it's affecting Kentucky taxpayers for last year especially. And then we have some other general individual provisions, including dependent care assistance expansion. So this would be like your DCFSA accounts and things like that, going from $5,000 to $7,500 starting next year. That's kind of a meaningful increase for people who use those. And then the child and dependent care credit percentage is also increasing from 35 to 50% of qualified expenses beginning next year. That I assume, will still be subject to phase outs for higher income taxpayers. But nonetheless, it's more of a benefit. I think this is kind of tuned into the rising costs of childcare that we all hear about and experience. The adoption credit has been modified to allow for an additional $5,000 that is refundable for 2025. So immediately, part of that credit will be a refundable credit. Previously, I think it could only have reduced any tax that you incurred back down to zero at the most. Now there's an ability to get $5,000 of it back. The deduction for moving expenses, which was discontinued during the Tax Cuts and Jobs Act 2020, 2017, 2018 through 2025, it's now been made permanently disallowed, except for the cost of moving certain intelligence community members. And then wagering losses, which have historically been deductible up to wagering income, so it could not create a loss. They will now be subject to a 90% deductibility threshold, still cannot exceed your wagering income. And while I initially thought that this might mean that all gambling income was going to be about 10% reportable, I think upon further reading, what it says is it's kind of like an NOL limitation, in that those losses, which in the cases that I see them usually greatly outweigh the winnings, those losses can only be used 90% of the losses. So in theory, I think they can still offset gains entirely and not create a loss. Regulations will let us know for sure. And then there are some new individual deductions coming, and I'm going to go through this quickly on the overview, and we'll get into them in a little more detail on the following slides. But these are the things that you heard about during campaigning. So tips, deduction for tips, deduction for overtime pay, no tax on tips, no tax on overtime pay, up to a certain amount. and a new senior deduction, a deduction for car loan interest, and the Trump account. So what does this look like? The deduction for tips will be in effect from 2025 through 2028. It affects employees and self-employed individuals, and they can take a certain amount of their qualified tips as an above the line deduction. Qualified tips are the kinds of things you think of as tips. So cash or charge tips that you give as a gratuity to your server in the restaurant or your barber, hairstylist, nail salons, things like that. The maximum annual deduction is going to be $25,000 on that, and it's going to phase out for AGI over 150,000 for a single filer or 300,000 for joint filers. And I did read that if both spouses in a married filing joint situation have tips, that I think it's a per person limit. Allison, I'm sure, can correct me if I'm wrong. And then this is an above the line deduction, so you don't have to itemize to get it. What does it mean to employers? W-2s will be changing. So in most cases, I think that all kind of payroll provider type companies were already separately accounting for tips as it is, and or overtime pay, which we're about to discuss. But so that should be more of a form manipulation rather than having to have employers do a lot of work to get this information disclosed. Again, regulations, and there's going to be kind of a grace period to get up to speed on both of this, according to the IRS, on both of these for employer-related reporting. Otherwise, it wouldn't be fair to spring something on you, in the third quarter and expect that you can, go back and retroactively and proactively report it correctly going forward. So more to come on that, but we think it's just going to be a W-2 manipulation to get these items reported. Same thing with the overtime pay, just different amounts. The overtime pay is the deduction is going to be in effect from 2025 through 2028. Overtime is simply that time and a half or double time. So it's the half or the, additional 100% that you're getting paid for working above and beyond whatever your requirement is. And then that's a $12,500 above the line deduction. And it's going to phase out at the same thresholds, 150 for single, 300,000 for joint filers. Doesn't matter, it's above the line. Whether you itemize, you're going to get it if you otherwise qualify. And again, there's going to be information returns required, read W-2s to report this so that the employer has given the information to both the IRS and the individuals who can potentially deduct it. So the new senior deduction, again, all of these kind of 5 bullet points, or the first 4, are in effect for 2025 to 2028. The senior deduction is an additional $6,000 deduction above the line for individuals age 65 and older by the end of the year in question. And if it's a married couple, then they can claim $12,000 as long as they otherwise qualify. The phase out for this is a little bit lower. So for single individuals, it's $75,000 and $150,000 for joint filers. Again, above the line, and all you have to do is be 65 by the last day of the taxable year. So all of those 12/31 birthdays, rejoice. And car loan interest deduction. This is also in effect for 2025 to 2028, and for purchases of qualified vehicles, you can deduct up to $10,000 of car loan interest. This phases out for single people at $100,000 of income or of AGI, and for joint filers 200,000 of AGI. You have to originate the loan after 12/31 of 2024. So this isn't going to apply to existing loans. It's going to apply to new loans and new purchases in 2025 and through 2028. And obviously the loan has to be secured by a lien on the vehicle. So this will not work if you've used your home equity line to purchase the vehicle. Qualified vehicles for this purpose are basically most vehicles with a gross weight rating of under 14,000 pounds. The key being they have to have final assembly in the United States. I'm sure there will be a large list of eligible vehicles, just like you can go out there and find the same thing for 179 and other items where vehicles are involved. So the Trump accounts, this is brand new, first impression, nothing to do with TCJA. And this is kind of like an IRA for kids that can be started for kids to be used later. Contributions are after tax and are limited to $5,000 per year, indexed for inflation. I also should mention that contributions may not begin until after July 4th of 2026, kind of giving everybody time to get prepared. And when I say everyone, I mean mutual fund companies, because these have to be invested in certain types of mutual funds. There's a fee cap on the mutual fund. There's going to be, the funds have to be primarily in U.S. investments, obviously. There are some exceptions to the $5,000 cap for certain tax exempt entities, and employers may also contribute up to $2,500 annually for employees' children's accounts, as long but this $2,500 counts against the $5,000 is what I mean to say. So the $5,000 after tax that I would contribute for a child, or if my employer wanted to contribute $2,500, I am not taxed on that $2,500, but it does count against the $5,000 that is allowed to go into the account for the year. So this will grow, presumably tax deferred, definitely tax deferred until used. And it will come out just kind of like an IRA that has basis. So you've made a non-deductible and maybe you have some other pre-tax deductions in an IRA. It'll come out the same way, net of the after-tax contributions, for the child who can access it as soon as they turn 18, if they so choose. One word of caution here is that it is still going to be subject, just like IRAs, to the 10% early withdrawal penalty that happens before age 59 and a half, unless it qualifies for one of numerous exceptions. And specifically for these Trump accounts, the exceptions that might come into play are an unlimited exception for amounts withdrawn for college tuition, and $10,000 to purchase your first home. And I think that one qualifies. That one is one of the exceptions to the penalty for IRAs generally. And then the most exciting part of all of this is that there will be a pilot program for children born between 2025 and 2028, where there will be an initial $1,000 contribution by the government for each baby who is a U.S. citizen. And then that kind of starts their nest egg or their college fund or whatever it is. And then, as Allison mentioned, some of these are tax cuts and some of them are revenue raisers. And all of these things are necessary to kind of make the world turn in the United States. And some of the revenue raisers or termination of incentives, a lot of them seem to focus on clean energy. So the OBBBA is going to get rid of the residential clean energy credit after this year, the energy efficiency home improvement credit, which was actually, kind of a bigger deal in the in previous years than it has been as of late. New energy efficient home credits, that one's, you get a little bit more time to use that one until 6/30 of 26, just in case you have those energy efficient new homes in process. Previously unclean vehicle credits and clean vehicle credits generally, those are going to be terminated for vehicles acquired after September 30th of this year. So again, this is kind of there's the carrot and the stick. This is kind of, we've reduced rates, or we've reduced, giving you all these extra deductions. This is kind of something to keep it a little bit more revenue neutral, if possible. And then I think Allison had previously mentioned that the reduced rates under the Tax Cuts and Jobs Act for trusts and estates are now made permanent. So that is the case, but I will remind you that the brackets for trusts and estates remained incredibly compressed. So when I said earlier that a joint filer reaches the 37% tax bracket at $751,000 and change of income, a trust or an estate reaches the 37% bracket for taxes at $15,650. So kind of a big difference there. Also, the expanded unified credit from gift and estate tax, transfer tax generally, has been left in place, and just for ease has been made $15 million per individual starting next year, and that'll be indexed for inflation. So since we've had portability around for about the same amount of time as the TCJA, a married couple will, in effect, as of next year, be able to give away during their lives or die with $30 million without paying any kind of a transfer tax on that federally.
And this was one of the larger provisions that taxpayers were hoping for, because if we reverted back to the 6 million, then there would have been a lot of planning opportunities this year.
Yeah, there would have been a rush on estate planning
Mhm.
attorneys at the end of the year. So good news in that regard, I guess.
Yeah. So as we've talked throughout, that most of these provisions are just permanent extensions, and that's the same with some of the business ones. And some of these are a little bit more taxpayer friendly, and they're ones that are going to be tax cuts in certain areas. So we'll go through some of those. So bonus depreciation. So we originally had 100% bonus depreciation, and that was set to phase out through 2026. And so it was decreasing by 20% each year. So we were down to only 40% deduction for 2025, a 20% deduction in 2026, and then it would be phased out completely in 2027. So the bill has extended that back to 100% bonus depreciation. There is an election for 2025 that allows for 40% bonus depreciation for qualified property that's placed in service in this first taxable year ending after January 19th of 25. And then, there are some reasons that you may want to elect out of bonus depreciation. If you have significant losses that you're going to be unable to take, it might make more sense to retain that basis in the property rather than having those losses just accumulate. There is a new qualified production property that's eligible for 100% bonus depreciation, and this includes non-residential real property that's integral to a manufacturing process, and it's placed in service after the July 4th date and before 2031. For 179 expense, so since with the 100% bonus depreciation, 179 expense hasn't been used as much as it used to be, but there are still certainly situations that you may use 179 instead of bonus. So that expensing limit is raised to $2.5 million. It's up from $1 million originally, and then the phase out threshold is on $4 million of property. So once you place in service $4 million of property in one year, then that $2.5 million deduction gets reduced dollar for dollar over the $4 million that's placed in service. And both of these limits are adjusted for inflation after 2025.
We also have business changes to research and development costs and the business interest deduction limit. U.S.-based R&D, first of all, R&D generally has been a huge kind of a surprise. So when the Tax Cuts and Jobs Act was created, in trying to balance that tax legislation, sorry, I was just losing the word for a second. What they said was, R&D has historically always been electively fully deductible. And the TCJA snuck in this provision where starting in 2022, which is kind of different than the rest of the TCJA generally, you were no longer allowed to deduct fully your R&D costs, and you had to capitalize them and amortize them over 15 years if they were US-based, 5 years, I guess, if they were foreign expenditures. And this took a lot of taxpayers by surprise because the whole professional community thought, well, they'll fix this by then. It won't actually kick in, but it did. So if you're on this webinar and you've been subject to this, because it probably changed your taxable income pretty dramatically up from 2022 through last year. But it's now back. As far as U.S. expenditures go, it's back to where it was, where they are fully deductible when incurred. All taxpayers, large or small, are able to actually fully expense the remaining unamortized portion of any R&D that they've had to add back in the past 3 years. Or you can elect to split that between 2025 and 2026. And even better for quote unquote small taxpayers, which in the business sense is average annual gross receipts of about 31 million or less, those taxpayers can amend. Those taxpayers can go back and change their 22, 23, and 24 if previously filed tax returns to expense. So that's going to be kind of a huge win for the companies who were involved in research and development and who were kind of somewhat penalized in that time frame of 22 to 2024. But for all companies involved in research and development, it's a big win. We've been waiting on this. We didn't think it would ever be a problem. It became a problem. And so if you are subject to this, you and I with you have been waiting for this change. Also, since the TCJA has been in effect, there has been a limit on the amount of deductible interest that a business can take under Section 163J. This has now been made permanent. It has kind of modified it somewhat because before, in order to calculate how much interest was limited, you were only allowed to consider your earnings before interest and taxes. So now they've kind of made that EBITDA. So your depreciation and amortization also is going to be added back so that you actually get a larger amount deductible of your interest expenses incurred in a business. And that kind of makes sense if you think about it, because interest rates have done nothing but go up since the TCJA, excluding COVID. And businesses have to pay more to finance equipment, to run operations. Interest is just a part of our daily lives as business owners. So this should affect the ability to deduct your investment interest or interest incurred in a business.
And this is also an area we were really looking for a change in legislation on.
Certainly.
So charitable contributions for C corporations. So there's now a new floor of 1% of taxable income that C corporations must meet in order to deduct any charitable contributions. There is still the ceiling of 10%. So a C corporation can deduct anything between 1 and 10% of taxable income in a given year. And any of those amounts that are limited would be carried forward for 5 years. So qualified opportunity zones. So this was enacted under the TCJA to promote economic development and job creation in distressed areas. So it allowed for a gain deferral of your capital gains, short and long-term capital gains, until 2026 to invest in these type of funds. So with the bill, the program is now made permanent. So it's going to be with rolling 10-year designation starting with January 1st, 2027. They did make several changes to the designation process for these eligible opportunity zones. And then it's going to allow for a gain to be recognized in the earlier of the year of disposition or 5 years after that investment in the qualified opportunity zone. So that is down from the 7 years originally. It increases the investment basis by 10% if it's held for 5 years, and then increases to the basis to fair market value on the date the investment is sold or exchanged if it's held for at least 10 years. So there are some new information reporting requirements, and they have imposed a $500 daily penalty for failure to comply with those penalties. Unfortunately, there's no change to the previous TCJA 2026 gain deferral date. So gains from that original qualified opportunity zone deferrals cannot be deferred again or rolled into a new qualified opportunity zone, which is what we were hoping that we may get out of this, but that didn't happen. So qualified small business stock, it expands the gain reduction on the sale of qualified small business stock by making partial exclusions of stock. So anything acquired after July 4th, 2025, it allows for shorter holding periods. It does raise the taxpayer exclusion ceiling from 10 million to 15 million. So if the stock is held for at least 3 years, it allows for a 50% gain exclusion. If it's held for 4 years, a 75% gain exclusion. And then if it's held for at least 5 years, then potentially 100% of the gain could be deferred up to the 15 million. And it raises that corporate gross asset ceiling from 50 million to 75 million. Another permanent extension was the new markets tax credit, and it allows for a 5-year carry forward for any unused limitations on that. And then a couple of other things which Elizabeth's going to talk about is the qualified business income deduction and the excess business losses.
Right. And as we are kind of swinging towards the end of our presentation, we will cover these relatively quickly, but these are permanent extensions. So something that we liked is the deduction for qualified business income under Section 199A. There are some small changes to the phase-in amounts and phase-out amounts that apply at different points in applying this deduction. But if you will recall, when the Tax Cuts and Jobs Act lowered the corporate rate to 21%, they kind of needed something to make S corporations and partnerships and pass-through entities more on an even playing field, because individual tax rates for the owners of such can go all the way up to 37%. So this was the 199A deduction that is pretty, broadly applicable with certain exceptions, where you can deduct 20% of your pass-through income before paying tax on it. Again, lots of different nuances to that calculation, but we are glad to see that it has been permanently extended. But along with that came a permanent extension of something we did not love as much, which was the excess business loss limitation, which was previously scheduled to expire in 2029, but is now permanent. And this kind of limits the losses that individuals can take above a certain amount. And there are new thresholds kicking in, currently $313,000 in 2025 and $626,000 for joint filers, but these will be indexed for inflation. It does, the amendment does, or the act does confirm that the NOL carryover treatment of these excess business losses is retained. So this was just generally meant to prevent anyone from taking exorbitant losses and kind of having them available, in the current year and forever. So it limits the losses that you are able to take in a given year above a certain threshold, and then kicks the rest into carryover treatment. Another piece of good news was despite lots and lots of worry and discussion, there should be no change to pass-through entity tax elections or treatment. This was pass-through entity tax, PTET elections are at each state's discretion and were kind of promulgated to get around the $10,000 state and local tax cap. So this, PTET generally means that a state has said, okay, a business can pay the individual income state tax of its owners. We see this a lot, obviously, in pass-through entities. And deduct it, at least for federal purposes, from the business income. So in that way, the pass-through owner has also kind of deducted their own state taxes on their business income without it having to be a part of that $10,000 SALT tax limit under itemized deductions. No change there. And finally, for the first time, at least in my professional career, the threshold for 1099 reporting is going to be changing after 2025. That'll be going from $600 to $2,000 with inflation adjustment starting thereafter. So that'll kind of alleviate some smaller businesses from having to report on 1099s, for contract labor or miscellaneous items, to the extent that those don't exceed $2,000. The 1099K reporting, and this is kind of like your batch credit card processors and whatnot, that reverts to the pre-2022 threshold of $20,000 and 200 transactions. And then, like I mentioned earlier, the W-2 reporting will have to be expanded necessarily to report overtime wages and cash tips or qualified tips for purposes of those deductions or exclusions.
1099 was just a much needed change to just help reduce an administrative burden on businesses.
Right. Right. So with that, I think we can move to the chat to address any questions in the 6 to 8 minutes that we have left.
Thank you so much, Elizabeth and Allison. This was so well done, and you really hit the highlights and did such a great job. We do have a couple of questions. One is, are the Trump account limits per child per year or per taxpayer?
I believe it's per account, so per child, per year. I know that the $5,000 is annual. I would assume that it is per child. Otherwise, what is the point? But again, those, as far as the government contribution, that's only going to apply to children born 2025 to 2028. And again, we can't start contributing to these until after July 4th of 2026. And that's kind of to allow the mutual funds to get their acts together and address fees and whatnot, so they can be a qualified investment of a Trump account. But I would assume at this point, and I will look and leave an email address for us so we can get back to you if we see anything differently. But my sense is it's per child.
Now, the next question, I do apologize if we did cover this. This just proves that I'm the marketing person and not the brilliant accountants that we have here. Will we be covering capital gains?
I'm not
Yes.
sure. Allison, do you know what that might apply to?
Whether there were any changes to capital gains?
The question was just, will you be covering capital gains?
Yeah, I think that would be in reference to whether there were any changes, because there's been lots of discussion over the years of
Yes.
changing those capital gain rates, especially the long-term rates, the lower rates. And no,
That
there were
didn't
not any
happen.
changes. Yeah.
We were happy to see that.
Yeah.
Well, those are the only 2 questions we had. We'll stick around for another minute or two to see if any others come in. But In the meantime, I'd love to say thank you again to Allison and Elizabeth. This was wonderful, and we always love partnering with Commerce Lexington, and we hope to see you guys at another Dean Dorton event soon. So we'll stick around, but thank you so much for attending today.